You've spent your whole life saving for retirement. 401ks, IRAs, maybe even a rollover or two. But there's a deadline coming. And if you're not ready for it, it could cost you big time. It's called RMDs, or required minimum distributions. RMDs are that pesky time in life when the IRS starts making you take withdrawals from your retirement accounts whether you need the money or not. In this video, we're going to walk through everything that you need to know about required minimum distributions, at what age they start, how to calculate your first one, what it means for your taxes, and optional strategies if you wanted to withdraw from your pre-tax accounts before the IRS requires you to. If you've got money in a traditional IRA, 401k, 403b, or other pre-tax retirement accounts, the IRS won't let you keep it there forever. At a certain time, you have to start taking withdrawals and, unfortunately, pay taxes on them. What are RMDs? RMD stands for Required Minimum Distribution. It's the minimum amount that the IRS says that you must withdraw each year from your pre-tax retirement accounts starting at a certain age. When we look at our three different types of accounts, or buckets as I like to call them, pre-tax accounts are things like traditional IRAs, 401ks, 403bs, pensions, and a number of other accounts. Now, you might be asking why? Why is the IRS making us do this? The reason is that you've never paid taxes on this money before. You might not remember, but when you elected to contribute directly into the 401k from your paycheck, this allowed you to avoid paying taxes at that time. Now the money has grown and grown for a long time, and Uncle Sam wants his piece of the pie. You might be thinking, well, what if I just don't take them? Well, you could do that, but unfortunately, the penalty is going to be 25% of every dollar that you don't withdraw that you were supposed to for the given year. Now, the penalty used to be 50%, which double time, much worse than it is now, but still, 25 cents on the dollar is not a penalty that you want to run into when we're talking about $50,000, $60,000, $70,000 at a time or more. So, knowing your RMD age and when to start them is critical. Thanks to Secure Act 2.0, the rules have shifted. It used to be that everybody had to start their RMDs at age 70 and a half. But now we've all picked up a few years. So if you were born in 1951 to 1959, you have until age 73 to start your RMDs. If you were born in 1960 or later, now you actually have until age 75 before you have to begin your RMDs. For your very first RMD, you get a little bit of a grace period where you're allowed until April 1st of the year following the year you hit your RMD age to take your original RMD. But after that, you have to take your RMD by December 31st every year. Otherwise, you could be subject to those 25% penalties that we mentioned earlier. Every RMD you take, each dollar you withdraw from your pre-tax retirement accounts get added to your taxable income for the year. This could mean that your RMDs move you into a higher tax bracket, could be more taxes on your Social Security benefits, or even higher Medicare premiums. See, your RMDs get taxed the same as ordinary income. For an example, let's say that you already had $90,000 of taxable income from Social Securities, pensions, cash earning interest, things like that. Now let's fast forward, you've hit your RMD age, and the IRS says that you have to take $40,000 out of your pre-tax retirement accounts. The $40,000 distribution is going to increase your total income from $90,000 to $130,000, meaning this RMD just caused you to go from the 12% marginal tax bracket to the 22% marginal tax bracket. Additionally, instead of your Social Security benefits, only 50% of them being taxed, now up to 85% of your Social Security benefits could be subject to federal taxes. And here's the kicker. You can't avoid RMDs. Even if you don't need the income, you're still forced to take it. Now, we have clients that take their RMDs, who reinvest the money into another account, but you're still going to pay taxes on the distribution. So you can see RMDs could have a huge impact on your taxes later on into retirement. I could take the next 10 minutes to show you a very complex calculation for figuring out what your RMDs are going to be each year, but I don't think that that would be the best use of your time, certainly not in this video today. So instead, let me show you the easy route and give you a quick resource that you can use to calculate up your RMDs. Below in the comments is a link to the Charles Schwab website. And if you follow that link, it's going to take you directly to a page that looks like this, where you can calculate your RMDs. It's very easy to use. Enter in your pre-tax dollar amounts, your age, so on and so forth, and boom, it will pop out and tell you what your RMD is for the given year or what it's likely to be in the future. For right now, there's only two critical points that you really need to know about calculating your RMDs. The first point is that RMDs are calculated on an individual basis, meaning that you're not combining both your and your spouse's pre-tax retirement accounts together to figure out the RMD. RMDs are calculated based on total pre-tax accounts for spouse number one, and then spouse number two has his or her own RMD totaling up all of their pre-tax accounts. Number two, all pre-tax accounts are considered when calculating your RMD. So you have to total up all of your IRAs, your 401ks, your annuities, any accounts that you have that are comprised of money that have never had taxes paid on it before go towards your RMD calculation. There's only one exception to the rule, and that is a 401k or another employer-sponsored plan while you are still employed. If you reach your RMD age and you are working for your current employer that also has $1 million inside of your employer's 401k, that $1 million is not going to be included in your RMD calculation. So there are some planning strategies that can involve retirement accounts for folks that are still employed when they hit their RMD age. Now that you know what RMDs are, when they're going to begin, and an easy way for you to calculate your RMDs, let's talk about some strategies that you could employ with your accounts before you reach RMD age. Now, you might be wondering, well, why would I worry about employing any strategies before I reach RMD age? I'll just let the money sit until I have to take it out if I don't need it. And that's one option, certainly. But here's something to think about. On average, if we're getting 6 to 7% per year on our investments, it's going to take about 7 to 10 years for that account to double. So let's just say that at age 65, you have $1 million inside of your IRA. Well, if we started a withdrawal strategy at age 65, even though we don't have to, we only have $1 million inside of a pre-tax account that we need to worry about. Whereas if I wait another 10 years and my RMD age is at 75, well, then this account is likely going to grow something like from $1 million to $2 million. So now, instead of us having $1 million of money that we've never paid taxes on, that the IRS is going to make us withdraw anyways, now we have a $2 million bucket of money that we've never paid taxes on that the IRS is going to make us take withdrawals from. And for that reason, sometimes for certain people, it can make sense to actually start removing the money from the pre-tax accounts before the IRS makes us. Option number one is something that we spent a lot of time talking about, and that's Roth conversions. If you're not familiar with Roth conversions, there's a link right here to a video that you can check out where we break down everything that you need to know. I'll also put a link in the comments below. Roth conversions are a strategy for intentionally removing money from your pre-tax account, paying taxes on it, and then redepositing it into a Roth IRA where now the money can grow tax-free forever. So Roth IRAs are one type of account that you can employ in a pre-RMD strategy. The reason for this is that Roth IRAs aren't subject to RMDs because we paid taxes on the money before we put it into the account. Strategy number two is what I call strategic withdrawals. For a long time, it was assumed that if you had money outside of an IRA when it comes time to retire, that you just use that money to live on and let the IRA grow for as long as possible until the government makes you take withdrawals from it. But with the uncertainty around taxes in the future and with people dealing with much larger amounts of money than they necessarily had to in the past, a strategy for strategically taking withdrawals, maybe as a combination of non-retirement accounts and retirement accounts prior to RMDs, sometimes can be a better way to go. If you're over age 70 and a half, you can make a direct, qualified charitable contribution from your IRA to your charity of choice. What this strategy allows you to do is remove money from your pre-tax account, make the contribution to the charity that you would have done anyways, but because the money went straight from your IRA to the charity, you don't have to pay taxes on the distribution. This is not only something that you can do prior to RMDs kicking in, but this is also a strategy that you can employ while RMDs are going on. How this works is, let's say you have to take that $40,000 RMD for the year. Well, if you're going to make a $10,000 donation to your church or alumni university of choice, instead of just making that contribution with cash, you could actually take $10,000 of the $40,000 distribution, donate it directly to the charity from your IRA, and that contribution will count towards your RMD, but also avoid ordinary income taxes. So charitable contributions are another strategy that you can employ prior to RMDs, but also during RMDs. Whereas the first two strategies that we discussed, typically Roth conversions don't make much sense once RMDs have already kicked in. And as far as strategic withdrawals, now we're to a point where the IRS is forcing us to take money out of the account anyways. And so it's not as strategic as it was prior to RMDs kicking in. These strategies take planning, but they can save you thousands over time. RMDs are just one of those things that don't seem urgent until they are. And by then, your options are severely limited. Understanding the rules now gives you the power to plan ahead, to keep more of what you've worked a lifetime to save. If you're within 10 years of retirement or already retired, it's time to start planning your RMD strategy. We offer free consultations to help you navigate this with no pressure or commitments necessary. If you'd like to find out how RB Wealth Partners can help you navigate this complex strategy, click the link below to schedule your free consultation. Thanks so much for joining us today, and I look forward to seeing you next time.